Welcome back to the deep dive. Today, we're cutting right to the chase on a huge financial hurdle. Needing a car, right? But hitting that brick wall because maybe your credit history is below average, maybe poor, or maybe just non-existent.
It really is the ultimate catch-22, isn't it? You often need that reliable vehicle for work, for stability, but the system for financing it, it's built entirely around evaluating risk. So if you have no track record or, well, a bad one, you immediately look like a liability.
Exactly. So our mission today, our deep dive, is really about giving you the blueprint, the preparation, the strategies, and yeah, the crucial warnings you need to navigate the auto loan market when credit is like your absolute limiting factor. We're going to treat this like a strategy game.
Okay, strategy game it is. And we have to start by maybe differentiating the challenge a bit, because lenders, they think about no credit and bad credit very differently. No credit just means, you've probably never borrowed money before.
Right, you're a blank slate.
Exactly. Lenders can't easily judge your risk, but sometimes they might be more flexible, especially, say, for younger borrowers with a steady job.
Okay, but then there's bad credit.
Yeah, and that's different. That means there's a history. Late payments, missed payments, maybe even defaults. That immediately marks you as a definitively high risk right out of the gate.
So here's the unavoidable truth then. Getting an auto loan in either situation is possible.
Oh, it's possible. Absolutely. But, and this is the big but, you have to be prepared. Prepared to accept significantly higher interest rates than someone with, like, a perfect credit score. That's just the price of the perceived risk.
Okay, so let's start the prep work. Before you even look at a car, you need this essential blueprint. And the absolute first step is what? Getting your credit report, knowing the score.
Yes. No excuses on this one. You have to know your starting point. Even if you suspect your score is low, getting that actual report is step one. And while, sure, a score of 600 or more makes life easier, it's not some hard limit.
So where should you focus your research then?
Look for financial institutions that specifically say they work with below average or subprime credit. Think credit unions especially. They often advertise this expertise.
Okay, and the next step. This is probably the most painful one for a lot of people. Defining your true budget.
Oh, yeah. People always focus on that monthly payment number, don't they? But that's a huge mistake.
It is. You have to include full coverage insurance. The lender will often demand it, right? With maybe $500, $1,000 deductibles.
Often, yes. Plus gas, plus maintenance, all of it. You absolutely cannot overextend yourself here. It's crucial.
Because the lender, they're doing their own checks in parallel.
They are. And they rely heavily on something called the debt-to-income ratio, or DTI. This basically measures your total existing monthly debt payments against your gross monthly income. The goal is generally 35% or lower.
Wait a second. For someone who might already be struggling financially or has past debts hanging over them, hitting that 35% goal, that sounds really tough, almost impossible for some. Does the lender maybe just focus on a minimum income floor instead? Or is that DTI the hard line?
That's a really good point. They absolutely do look at income. While a good DTI is definitely helpful, many lenders will accept higher ratios if the income is verifiable and, importantly, stable. What's really critical is often that income floor. Most places want to see at least, say, $1,500 to $2,000 in monthly pre-tax income, just to even consider the application.
What?
That minimum level of stable income, it's everything when the credit file is thin or non-existent.
Right. It sounds like if you don't have the credit history, you better have an absolutely flawless financial paper trail to compensate. Speaking of paper, the document checklist, I bet it's pretty hefty for a tough approval like this.
It can be, yeah. And being prepared here is the only way to avoid those frustrating last-minute approval delays. So make a checklist. Proof of identity, that's usually easy. Government-issued ID.
Okay. But proof of income, that feels non-negotiable if your credit is shaky. Standard employees, they need pay stubs, W-2s.
Oh.
But what about, like, the millions of contractors or freelancers listening? Their income can be variable.
Great question. If you work for yourself, yeah, you need to get your latest Schedule C from your tax returns ready. Banks and lenders often take longer to verify variable income, so having that tax documentation handy, showing a consistent earnings history if possible, that's crucial.
Good tip. And don't forget proof of residence, utility bill, lease agreement, mortgage statement. Especially important if the address on your ID doesn't match what the credit bureau has, right?
Exactly. Mismatched addresses cause delays. And obviously, if you've already zeroed in on a specific car, have the details ready. The VIN, make, model, and the purchase price. makes the application smoother.
Okay, documents locked, income verified. We know where we stand financially. Now, before we go anywhere near a lender or dealership, we need to talk about the power of pre-qualification. You mentioned this briefly. This step feels non-negotiable.
Oh, absolutely. Pre-qualification is a game changer. It really is.
Yeah.
Because it lets you see what loan amount and terms you might be eligible for without triggering a hard credit inquiry.
And those hard inquiries ding your score, right?
They do. Even if it's just a few points, multiple hard inquiries can add up. So with pre-qualification, you can shop around with multiple lenders, banks, credit unions, online folks, get a feel for offers without penalty until you find the best potential rate.
Smart. Okay, so when looking at those lenders, can we kind of rank them? Based on how friendly they generally are to applicants with below average credit, I'm guessing, based on what you said earlier, credit unions are probably at the top.
Absolutely. They usually are, because they're nonprofit institutions. That structure often allows them to be more, well, personable. They might be more willing to look at your whole financial picture, things like your job history, your savings habits, not just that single credit score number.
Right.
Plus, they often have slightly better rates and sometimes even specific credit builder loans designed exactly for people in this situation.
Okay, credit unions first. What about traditional banks next?
Banks are next, yeah. They offer regular auto loans, of course, but they usually demand a bit more proof of responsible financial habits. Now, if you already bank there, have your checking and savings accounts with them, that existing relationship, that can definitely help. It can tip the scale sometimes.
Makes sense. Then there are the online lenders.
Yep, convenient for sure, great for comparison shopping from your couch. But, and this is important, proceed with caution here. Criteria vary wildly. And for borrowers with less than perfect credit, some online platforms might hit you with surprisingly high interest rates. You really need to compare their offers aggressively against what a credit union might offer.
Okay, compare aggressively. And finally, there's the path of, let's say, least resistance, dealership financing.
Ah, yes.
Yeah.
The dealership. It's convenient, no doubt. The dealer handles the shopping around with various lenders for you. But always, always remember, they usually mark up the interest rate they get from the lender. That's part of their profit margin.
So if you walk in without a pre-qualification offer already in your pocket from a bank or credit union,
You have zero leverage. Exactly. They hold all the cards on the financing side.
okay, leverage is key. Before we jump into specific strategies to gain that leverage, we need to pause on something you touched on. The huge difference in interest rates based on the type of loan. Secured versus unsecured. The gap seems staggering.
It really highlights how critical the lender's perception of risk is. A secured loan means the car itself acts as collateral. So if you default on payments, they have the right to take the car back to recoup their losses.
Okay, so they have security.
Right. That reduced risk for them translates directly into significantly lower average interest rates, often around, say, 7% on average for auto loans. This secured type is often required for newer cars or higher value used cars.
That 7%, that actually sounds pretty reasonable, especially compared to some of the numbers we might see later.
Yeah.
But an unsecured loan, the kind that isn't backed by the car or any other asset, that's where the rates really jump, isn't it?
Yes, precisely. It's much higher risk for the lender. If you default, they have less recourse to get their money back easily. And you see that risk reflected immediately in higher average interest rates, sometimes spiking up to 10% or even 11% on average.
Wow, quite a difference.
And this unsecured route, it's often the only option if you're looking at like a cheaper, older secondhand car. Maybe one valued under $10,000, which is what a lot of first-time buyers or folks rebuilding credit are targeting.
Okay, so if the collateral itself makes the difference between, say, 7% and 11%, that tells us something important. It means minimizing the lender's risk has to be our primary strategy here.
Right.
Let's talk about the key leverage points then, the things you can do to win approval even without that perfect credit history.
Right, and the single biggest lever you have, it's the down payment. Putting money down directly reduces the amount you need to borrow. That improves the loan-to-value ratio, the LTV, which lenders watch closely. Plus, frankly, it just signals financial stability and seriousness on your part.
Okay, makes sense. But what's the magic number? How much of a down payment actually makes a real difference in their eyes?
Well, experts typically recommend aiming for 10% to 20% of the vehicle's purchase price, if you can manage it. Think about it. Borrowing less money simply means easier approval and less risk for the lender. And that usually translates into better loan terms for you.
Okay, 10% to 20%. That's still a significant chunk of change for many people, especially if finances are already tight. If that kind of lump sum just isn't feasible, what's the next best option? Finding a creditworthy cosigner.
Yes, that's the next major leverage point.
Mm.
If you can't put significant cash down, you essentially borrow someone else's good credit. A cosigner, ideally someone with a solid credit score, say 660 or higher, is often recommended, agrees easily to pay the loan if you default.
And that helps how?
Oh, it dramatically increases your approval chances. And it can often secure interest rates much closer to what the cosigner themselves would qualify for. It's a huge boost.
But let's be real for a second. Finding someone with great credit who's willing to take on that level of risk for you, that's a huge ask. What if that's just not an option? Maybe someone doesn't have a reliable, financially secure family member or friend willing to do that.
That's a very fair and common situation.
Yeah.
And it forces you back to proving your own stability, just in different ways. Since you lack that formal credit history or have a damaged one, you have to focus on demonstrating stability through consistent income and reliable work history. We talked about the documents for that.
Right.
And some sources even suggest gathering things like your utility bills or phone bills, bills you have paid on time. Bring them in to show a strong history of responsible payments, even if it's outside the formal credit reporting system.
Ah, okay. So you're essentially building like a parallel character profile for the lender, showing them that even if you didn't have a credit card, you always paid your electricity bill on time for the last 2 years. That makes sense. And while you're proving stability, you should also be researching the car's market value, right, to negotiate.
Absolutely. Use tools like Kelley Blue Book, KBB, or similar sites. Know what that specific car is actually worth in your market. If you can negotiate the purchase price down, even by a little, you minimize the total amount you need to borrow. And borrowing less is always, always an approval boost.
Good point. Always negotiate. And finally, we have the long game strategy. If your timeline allows for it, say waiting maybe 6 to 12 months, building some credit first seems like the financially optimal choice.
It absolutely is if waiting is feasible. You can start small, maybe get a secured credit card. That's where you put down a cash deposit as collateral, and they give you a credit limit usually equal to that deposit.
Okay.
Or another option is becoming an authorized user on a credit card belonging to someone who is financially responsible and has good credit. Their good history can sometimes help build yours. Doing either of these things for 6-12 months, making small purchases and paying them off on time every time, starts building that positive history, which will make the actual auto loan process exponentially easier and cheaper when you are ready to apply.
And of course, the ultimate alternative to all this borrowing stress is just avoiding debt altogether.
Right. Pay cash. If you have the savings, buying an affordable, reliable used car outright, especially maybe one under $10,000, eliminates all the interest worries and monthly payment stress.
Huge relief there. But there's a trade-off, isn't there?
There is. By paying cash, you sacrifice the opportunity to build your credit history with what lenders see as a major installment loan. An auto loan paid well looks really good on a credit report over time.
So it's a balance. Immediate financial relief versus that long-term credit building opportunity.
Exactly. It's a trade-off you need to weigh based on your own situation and goals.
Okay, we have covered a lot of ground on how to prepare and strategize, but we absolutely have to finish this deep dive with a major warning. A flashing red sign, really, for anyone trying to finance a car with little or no credit. The buy here, pay here model, BHPH. This is generally not the fallback option you should be considering.
This is such a critical alert. These BHPH dealerships, they market heavily on things like guaranteed approval or no credit check needed. They can do that because they act as both the car seller and the lender. You make your payments directly to the dealership, often weekly or biweekly.
Sounds convenient on the surface, but the hidden dangers. They sound truly predatory based on the research. Sources highlight interest rates that are just astronomically high, typically ranging from, 18% up to maybe 29%?
That's right, 18% to 29%. And just to put that in perspective, we were talking earlier about traditional subprime auto loans maybe being the 4% to 10% range, maybe a bit higher. This BHPH stuff is often double, triple, even quadruple that rate. It's incredibly expensive money.
Wow. And the quality of the vehicles usually matches those interest rates, unfortunately.
Usually, yes. The cars often lack verified maintenance history. They rarely come with any meaningful warranty. Proper inspection might be questionable. And they're often severely overpriced, sometimes sold for nearly twice their actual market value using as-is contracts. So you're paying incredibly high interest on an unreliable, overpriced asset. It's a terrible combination.
And because they are both the seller and the lender, their repossession policies can be notoriously aggressive. They're almost designed to profit from failure, aren't they?
That's often the criticism, yes. Many BHPH contracts allow the dealer to repossess the vehicle incredibly quickly, sometimes after just one missed payment. And they often install GPS trackers and even remote engine immobilizers or disabling devices to make that rapid recovery easier for them.
That's terrifying. And here's maybe the cruelest part, especially for someone genuinely trying to get on their financial feet.
What's that?
Most of these BHPH dealers, they do not report your positive payment history to the major credit bureaus, Equifax, Experian, TransUnion.
That's a huge downside. You can make every single payment diligently, on time, for 2 or 3 years, and at the end of it, you still haven't established the positive credit history you needed in the first place. You haven't improved your score to get out of needing BHPH in the future.
Exactly. It keeps you stuck in that cycle. So the takeaway is crystal clear. Avoid the BHPH trap if at all possible. The better path requires that preparation we talked about, nailing down your real budget, gathering all those documents, seeking out friendlier lenders first, like those credit unions, and then using leverage, like a significant down payment or, if possible, a trusted cosigner to minimize the risk you present to the lender.
Absolutely. Knowledge is power here. By executing that kind of strategy, you're actively working to minimize the lender's risk. And minimizing their risk is the only real way you're going to minimize the interest you have to pay.
Okay, so we've established that these really high-risk lenders, particularly the BHPH dealers, often seem to profit significantly by, well, cycling the same poor-quality cars through multiple repossessions. They collect high down payments each time the car goes out. So here's a final thought for you, our listener, to mull over. If, moving forward, more borrowers in this situation really prioritize avoiding those sky-high interest rates, maybe by choosing a secured loan through a credit union instead, even if it takes more effort, or by saving up to pay cash for a cheaper, reliable vehicle, what kind of broader, maybe structural changes might that force in the high-risk auto financing sector? If that cycle of repossession and high down payments becomes less profitable, where does that industry turn?
That's a really fascinating question about market incentives and risk structures, isn't it? Something to definitely think about as you consider your own next steps. Thank you for joining us for this deep dive.
We'll catch you next time.